What's going out there? It's April 28th. And I'm Frank Curzio, host of the Wall Street Unplugged podcast, where I break down headlines and tell you what's really moving these markets. I spent some time with the family this weekend. Went to St. Augustine. Nice outlets over there, about an hour away from our house. You have to drive through Jacksonville to get there. I do like every 4 or 5 months, buy clothes and stuff, the family and everything. Kind of like a routine. But I was surprised. We called ahead and they said they're open till 9, which we kind of expected is Saturday night. When we got there, and we got there kind of late, more than half the stores were closed before 7 p.m., which is weird. Usually they all have to stay open at the same amount of time, especially, if you have a mall, kiosks, or whatever you operate within that environment, you usually have the same hours as every other store. And many of these stores didn't explain why they were closed. I was looking to see if they were still in business. But these are good brands, still in business, doing well. They just closed. And a few others had signs saying that they were short-staffed. Let's go shopping for about 2 hours. Driving back home. Took about a half an hour to get to Jacksonville before we go a little bit, about another 30 minutes north to Amelia Island. There's another big center over there, and everything kind of closed at 10. We got there like 9:30. So we're hungry. It's like, let's stop. I love going to Chipotle. Love it. Get that probably maybe twice a month. It's supposed to close at 10 o'clock. Get up to the door. There's a sign on it saying that they closed at 8 p.m. I was like, okay, great. Nothing on. Just, hey, we closed early. We closed at 8 p.m. So there's one other place that's open after 10, or maybe one or two of them over there. There's a lot of different restaurants. Most of them close at 10. Buffalo Wild Wings. They're open till 12. Been there plenty of times. I'm like, okay, we'll go to Buffalo Wild Wings with the family, hang out, watch some sports, TV, play trivia, whatever. So before we do that, let's just hit like a store because it is an area. And one of the stores that happen to be open till midnight, which is Burlington Coat Factory, which, holy cow, that stock's on fire. And you can see why if you go there. They just have better brands for cheaper prices than TJ Maxx, Marshalls. Seriously, you should go there. It's pretty cool. So we'll go there for like an hour and then we'll go eat. Okay, fine. So now it's like 10:30, 10:45. Stay with me here. So we go to Buffalo Wild Wings, which is in the same, area. And they have a sign on the store saying that they're closed. They're closed because they're short-staffed. And they were closed at 8 p.m. And they said if you come in after 4 p.m., which is another sign, it said you can't come in with parties more than 5. We just don't have enough people to accommodate you. Remember, this is Saturday night, guys. This is Saturday night, right? Big day for all restaurants, all bars, everything. It's supposed to be open. So we tried another restaurant. It's supposed to be open till 11. They also closed around 8, 9 p.m. Just about every one of these stores, the reason why they were closed is because they were short-staffed. They can't find people to work. You got to think about that for a minute. Because the one restaurant that was open till 12 a.m. in the area, we drove to, it's across the street. There was a line out the door. So I called to see, hey, how long's the wait? You have seats available. They said it's more than an hour wait. They're open till 12. We're there probably around 11:10. So basically an hour wait, and they close in 50 minutes, which is interesting. Good for them. Good for them. They stayed open. They have people working for them. They're doing great business. But you see, most aren't. I'm curious to hear from you. FrankCurzioResearch.com. Casinos everywhere right now. McDonald's was also closing Jacksonville. Supposed to be open 24 hours. So we had no choice to eat the very healthy and awesome Arby's. Can't believe Arby's is still open, actually. Still took 25 minutes to go through the drive-thru. Mozzarella sticks, a couple chicken sandwiches. That's all we could get. We're all starving. Now, I've been getting lots of emails from you. And this is important because the reason why we're able to see COVID early, the reason why we get into trends early, a lot of it is because of you. This is a network. This isn't about me. I say that all the time. What I learned from everyone out there who's in these specific industries is amazing. And so many of you, I can't tell you the number of doctors that email me for COVID that listen to this. And it's not just business owners, it's students and telling me about different trends and, Facebook buying Instagram and everybody thought Zuckerberg was nuts. These kids are like, this is the greatest thing ever. It's awesome. Remember, they wanted to get its head on a platter. Just get rid of him. Paid $2 billion for that. What is it worth? Like $50 billion or something? $50 billion? People just didn't get it. He got it. And the only reason why I got it and understood it and looked more into it was because I had a lot of young investors email me telling me this. You don't know everything. No matter what you think, you might be a professional in your field, but when it comes to everything, you don't know. So when it comes to this network, that's the power of this podcast. It's why we do so well in the portfolios. We're able to get into things earlier, see the risk coming, and that's from you. It's not a bias. If you say, hey, business is bad across the board, I'm getting 90% of those emails, then I'm going to come out and say, hey, guys, be careful here. Or vice versa, when everyone thought the market was going to crash for the last 4 or 5 years, I'm getting emails saying business has never been this great in our history. Orders through the roof. I'm telling you, pedal to the metal. Stocks can go higher. Now, the recent emails you've been sending me, I'm not going to bore you and read every single one of them, but I am going to read one of them to you. This one's from my buddy Steve. He goes, so the wife and I were down in Logan, Ohio this past weekend, a vacation rental in Hocking Hills region. We're looking for a new couch for our place. We stopped into a local family-owned furniture business that carries a pretty nice line. Now, this is right smack in the middle of rural Ohio. Logan is super small, and these are salt-of-the-earth people. As we started a discussion with Denise, the owners of the store, she proceeded to completely outline and explain what's been going on within the entire supply chain economy. She explained that anything we order will take 8 to 10 months to be delivered. She explained how this is not a direct result of supply-demand issues, but employment issues. They can't find any workers. The entire supply chain can't find workers. She explained how every aspect for the companies that make the foam all the way down in Texas to the lumber companies that supply the wood to the companies that make the fabrics to furniture, supply, shipping, they can't hire people. And this completely bottlenecked the supply chain have taken prices considerably higher for furniture. She actually said to us that she would not be working at her family-owned store if it wasn't for a family, because she would be making more money if she were unemployed. So here's middle rural America, it's still Steve talking, a small pocket being impacted by all this, and these people fully understand what is happening. The mechanics of it, they've done the math, they get it. And what is interesting is that this inflation seems to be an artificial byproduct of our government continuing to inject massive dollars into the system. It's not a supply issue because there's lack of raw materials. They've got the stuff. They just don't have the people, anything, or to work because they're hooked on fiscal crack. P.S. We ended up not ordering the couch. The price has doubled, and we would have had to wait 10 months. Just another data point. I can't tell you how many emails I get. I love getting emails like that. Okay, I didn't mean to read it and just bore you, but this is happening everywhere. Now, let's move on from this, because a lot of this stuff has been happening in the past couple of weeks. And 3 weeks ago, we saw the 10-year coming down. GDP is kind of like, just at a steady level. 3 weeks ago, the Fed coming out today saying, well, we don't have nothing to worry about or whatever. It would have been okay. But the past 3 weeks has been nuts. 3 weeks. Now, look at the companies who just reported earnings this week. I want you to listen to these numbers. Please pay attention because this is amazing. So Google reported quarterly earnings of $26.29. That was over $10 better than consensus estimates, which is $15.64. Revenue rose 34% year over year to $55 billion. 55, that's for the quarter. That's for the quarter. $55 billion. Revenues, 34% year over year. NICE being the biggest company in the greatest secular growth trend in history, which is digital advertising. And to put a cherry on top, Google announced, we're going to do a $50 billion buyback. I can imagine what was going on at the board, right? They're like, let's have a buyback. Let's do $20 billion. You know what? Let's do $30 billion. Let's go to $50 billion. That's fine, $50 billion. $50 billion, guys. You know how much money that is? And put that in perspective. That's higher than the market cap of 350 of the 500 companies in the S&P 500. This is a buyback. A buyback. We have nothing else. We have so much money. We're just going to buy back our stock. And by the way, with those earnings, you're going to do it definitely the cheapest of all the FANGs. Even though it's up the most over the past 7 months, it's surged higher than the market, outperformed every one of the FANGs by a mile, and it's cheaper than all of them. If they continue earning $26 plus every single quarter with a $50 billion buyback. Are you kidding me? Blowing out estimates. Microsoft, again, this is all on Tuesday, put a $41 billion in sales for the quarter. That was 18% better than expected, 20% year-over-year growth. Yeah, the stock came down a little bit because it's run up incredibly high. I'm not talking about the stock prices because a lot of these companies have run up tremendously. So they're going to take a breather. Like Microsoft. And I get it. A lot of it is computer sales and Surface sales. And, I don't know if you're going to see the impact from that going forward. I'll break that down later with Daniel. Did you see AMD's numbers? put an earnings of 52 cents a share, blowing out the estimates. Revenues rose 92% year over year. These are mature companies. These aren't small businesses that, it's easy to grow revenue 100, 200, 300, 400%. No, these are mature companies doubling their revenue year over year. And this quarter is comparable to pre-COVID. This isn't, COVID numbers were really bad. No, this is pre-COVID, right? This is the quarter pre-COVID. This is the 3 months prior to COVID. They issued upside guidance, said revenue is going to grow at least another 50% next year. These see numbers from UPS, $2.77 per share. Again, I don't just throw a number at you without putting it in perspective. It was over $1 better than estimates. That number was more than 100% higher than last year. Revenue rose 27% year over year, $22 billion, much, much higher than estimates. You know what it was driven by? A 14% increase in volume from a year earlier. Huge, massive demand. They also said market demand's outpacing industry supply. This is why you have to listen to conference calls, guys. I'm getting to a bigger point here. But listen to conference. Don't listen to UPS because you don't have to listen. You could get the transcripts for free any place. Just go Google transcripts UPS. But they give you like a UPS, a GE, infrastructure companies. They're going to give you a perspective of so many different areas, so many different industries, these conglomerates. So you want to listen to them because you probably get so many different ideas listening to these conference calls. So don't listen to UPS because, because you want to buy UPS, you want to sell you. No, listen to it because, trust me, it'll give you 15, 20 different ideas. Because they got a call that said market demand's outpacing industry supply. No kidding. But UPS says this dynamic, they expect it to continue for the foreseeable future. The key economic indicators continue to support the recovery in 2021. No kidding. Then you had a couple firms upgrade UPS. One of them upgraded. I won't make fun of them. From a sell to a hold. Probably a smart move. Probably. A little late on that, but probably a smart move with those numbers, UPS. Because the numbers are going to go higher and higher. Lots of money out there. Earlier this month, what do we see? This month. GM and Ford idling their plants because there's not enough chips to put in these cars because of crazy demand. People say, this is their game. No, they're not coming back online. There's still several. Ford said the Chicago plants, they're still idle. They're still having trouble. And reading Steve's email, this isn't like, hey, just a supply issue either. It's going to be a labor issue. What else are we seeing? Copper, 10-year highs, close to its all-time high of $4.69 a pound. What is it, around $4.40 today? Lumber, everybody knows about lumber now. It's up 325% over the past 12 months. 325%. Corn likely going to hit an all-time high. Wages are starting to surge, which is why it's so difficult to find help. People want more and more money. Plus, people are still making money or more money staying home right now, which is insane. Look, it's everywhere. It's being reported everywhere. Democrats, Republicans talking about a $1.5 trillion infrastructure package on the way, on top of the $10.5 trillion in monetary and fiscal stimulus, which was already injected into this economy. Household wealth. This number is awesome, guys. Household wealth, all-time high, is at $138 trillion. Household wealth is, if you're owning assets, your home price is going up, that's your household wealth. $138 trillion. That's up 25% over the past 5 quarters. A little over a year. The average existing home price up 17% year over year. Usually we see what historically, dating back 30, 40 years, 2-3% annual rise. 17% year over year. But interesting, home sales dropped in February and home sales dropped in March again. Mortgage rates have come back lower. You know why? Because there's no homes for sale. There's only 1 million homes for sale at the end of March. That represents a 2.1 month supply. To put that in perspective, that's down 65% from the average, which is just over 6 months. There's usually a 6 month supply. It's 2 months. There's no houses. That's why. That's why the housing numbers are dropping. The home sales. Food prices, look at the Bloomberg Ag Spot Index. Just Google it. You can look it up any place. Surged the most in 9 years recently. Have you listened to some of these calls? People reporting now. Almost every food and beverage company said they're raising prices. Procter & Gamble, Coca-Cola, Pepsi, Kimberly-Clark, General Mills, Mondelez, Hershey's, James, all of them. raising prices. Freight companies are raising prices. Logistic companies are raising prices, which is now showing up in key indicators. We had Goldman come out today. I don't know if you saw the note. Got a lot going on with the Fed, Biden's plan, all this stuff. Said oil is going to $80 in 6 months. It's 30% higher than it is now. So you see huge demand. You're seeing all this, but now those key indicators that the Fed looks, import prices and the CPI, I mentioned this last week, core import prices up 8.6%. It's in a compound annual rate, 8.6%. You know how much that is? It's insane. Man, it sounds like a lot. It's a ton. So CPI just reported. That's the Fed's most watched gauge when it comes to inflation. Again, it's manipulated. It's been done since the Reagan years to make it look like, hey, it's just rentals and stuff. To keep inflation as low as possible. To not show up what everybody knows is inflation. And even that, based on CAGR, is at over 4%. We have almost every single asset. Think about this, guys. Any of you out there, you own a house, you own every single asset. Collectibles, homes, stocks, cars. You know what? We're probably, if I had to guess, around 50% capacity in terms of every state opening every store and having no more masks, lifting restrictions totally. Which are telling you to get the vaccine. You need to get the vaccine, but you still have to wear a mask. Why? Because you might infect other people. So that's fact. That's what we're being told. That's why we got to wear. Why get the vaccine if you still have to wear a mask? You have no worries, right? Why? It's crazy. Anyway, nobody cares. But all this stuff's going away, right? They have no choice. The stats there. It's going to start opening up. My point, all these numbers are about to get even crazier with everything opening up and everybody spending money. So bringing it all together, I have a question. Just one question. And it's pretty simple. Why is the Fed not pulling back? The Fed achieved its objective. They wanted to create inflation. It's here. It's now. It's running wild. So why are we not looking to raise rates? Or at least talk about raising rates later this year? What the Fed usually does. They usually get ahead of things and say, this is what we're going to do. This way it's sugar-coated and expectations are met. But you're really still talking about this is going to happen to 2023? You're not going to raise. Are you insane? Why is the Fed still buying government bonds? Why are we still injecting trillions into this market? Listen to Biden today in his speech. You're going to see much more money is going to be injected into this market. Why? Are you crazy? And now we're starting to see some pretty smart people talk about inflation a little bit. In fact, if you looked at the S&P 500 companies that reported already, they have cited the term inflation. This is based on FactSet data, which I love these guys. So they cited the term inflation on their earnings calls for Q1. And through this point in time in the earnings season, it's the highest that they've done this in more than 10 years. That they've seen that word inflation creep up. Again, we haven't seen inflation in 10 years, 20 years, 30 years. But the most in 10 years, companies have mentioned the word inflation in their quarterly presentations. Companies already reported. But those inflation worries, those mentions, they're just like concerned a little bit. They're talking about 2%, 3% of the CPI. You're looking at inflation expectations, which is a gauge, and I think this is Evercore here, rose to 2.43%. It's the highest since 2013. So economists, even though it's the highest since 2013, are only expecting around 2.5% inflation, which is insane. We're already over 4% on the CPI. They're not talking about 10% inflation, which you could easily make an argument for. I know that number sounds crazy, but this is exactly where we're headed unless the Fed puts the brakes on right now. Right now. If you're invested, stocks are going to ramp higher for the next few months, maybe a quarter or two. The Fed doesn't put the brakes on, or at least just talks about it. We're doing this, taping this a little bit before, the Fed meeting, but, usually release a statement. They said, they're really not going to talk about raising rates yet. Let's see. Maybe that changes over the next hour or so. They don't have to put on the brakes And we're going to see inflation beyond belief. It's here right now. Everywhere you look, every asset class is surging. And you, just average retail folks, know it. You're going to know more than the economists. Looking at these stupid bell curve charts, lock themselves in a room talking to rich people, they get it so much later. They wait 3 months to report some of these statistics, and then they revise them 3 times after that. Over the next 3 months. You're seeing it. You're seeing it with your neighbors. You're seeing it in everything you buy, tuition, electricity. You're seeing it everywhere. And it's going to get even crazier. Because the whole U.S. is about to open up, and everybody has a lot of money. But everywhere you look, every asset class is surging. And you know what? I don't trust the Fed, and I definitely don't trust politicians to do the right thing here. I don't. And you know what? Billionaire bond king Jeff Gundlach doesn't either. Yesterday, he came out, said he thinks the Fed is sweeping aside the growing risk of runaway inflation, and says the central bank is just guessing at this point. This is the guy, Jeff Gundlach. Billionaire, bond king. This guy knows inflation, everything, much, much more than I do. And this is his job. 40, 50 years been doing this. This guy, and he's extremely worried, saying the Fed is sweeping aside the growing risk of runaway inflation. Runaway inflation. This isn't me like shouting on the rooftops. Look, no, this is coming out now. Mark Zandi's economist said the same thing. You got to start pulling back. And I don't know if they're going to do it. Okay, I'm not predicting a huge market crash or anything like that, but you have to start hedging yourself. You have to protect yourself. Take a little bit off the table. You could buy long-dated puts. That's not shorting because the market could surge from here. We saw that with numerous stocks that you thought were going to come down a lot, and they didn't. And these things usually go a lot higher before they go lower. But you can hedge 5%, 10% of your portfolio. Just be safe. You can't go all in here. There's no way you can go all in. I mean, it's not about valuations. They're going to continue to skyrocket. Low interest rates. You can't look at a stock based on valuation. I mean, you have to remain long here, but, again, we're inflating the markets. Profits are going to be, the average company, S&P 500, is beating profits by 30%. That's unheard of in the history of to be tracking this for, 20 years? You can buy inverse ETFs. It's a little bit easier. I mean, don't go higher than the 2x ones. People like getting the 3x ones. Because, again, if you're wrong, you're really going to be wrong. But you only lose the money you put into those. Okay, we can go a lot higher before we go lower. But when it comes to inflation, and I just said this last week. I'm not going to repeat it. But when it comes to inflation, it's the one problem the Fed can't stop immediately. It takes many, many, many years, even decades, to stop runaway inflation. You just look at the 60s, the 70s, and 80s. And you could print money to capitalize banks. You could print money when, long-term credit, when people F up. I won't curse. You can capitalize failing institutions. You could bail out businesses. I mean, you could print as much. Look at COVID. COVID crushed the markets. You know how long? For 45 days before the Fed. And I had no idea the Fed was going to do this. This is why, otherwise I would have been buying right away through April. It took me to May to realize, holy cow, they're throwing out trillions. They said trillions of dollars they're going to hand to people, checks, and businesses, and loans that they don't have to pay back. You had to get bullish again. How quick did we recover? Almost immediately. Pretty simple. Just print $10.5 trillion. We're good. What, $10.5 trillion? We'll do 15 trillion. We'll do 20 trillion. Doesn't matter. Just keep printing until we're okay and keep rates at zero. With inflation, you have to take money out of the system. Instead of buying treasuries, the Fed has to sell them. You have to raise rates. You have to take away the punch bowl. No more stimulus. And nobody wants to do that because we're addicted to it. And we've never seen the consequences of this because we haven't had inflation while we have interest rates low almost forever since the credit crisis. But those are the only ways to control inflation. And the worse it gets, the higher inflation gets, the more difficult and the longer it's going to take to control. So I don't know what the Fed's going to do. I know what our politicians are going to do. They're going to continue to spend money, give free money to everything, colleges, everything for free, right? To buy votes, whatever they want to do. That's fine. But enough is enough because when you see these people making enough money where they're not going to work. They don't need to work. We're seeing it in stores everywhere. Again, Frank Curzio, I want to hear from you. Let me know what you're seeing in your neighborhood because I'm seeing this all over the country. I don't care what the Fed does. I don't care what politicians do. What I care about is you. And you need to protect yourself right now. If you're doing this across all your portfolios, again, just maybe take a little off the table. So those of you subscribers to Money Flow Trader, which focuses on buying long-term dated puts, hedging yourself, pay close attention to Ginny's advice because she's going to kill it. I have to tell you, you don't have to wait for a market crash for that to happen. We're seeing a lot of individual stocks down 20, 30, 40% from their high. Look at those ESG names, a few marijuana names, a lot of these just crazy stocks that ran up tremendously. In the last 3 months, look at the Russell. There's a lot of stocks down 20% plus. I say about 30% of the Russell. A lot of these names are getting crushed if they're in the wrong industries, if they had inflated valuations. Money's rotating out of them. Money Flow Trader, Ginny takes those individual names as long-dated puts, and those gains, like we saw during COVID when the market did come down tremendously, are 3x, 4x, 5x, 6x. That's why if you hedge your portfolio just a little bit with these things, and you're right, yeah, the rest of your portfolio would come down, the long positions, but that part of your portfolio, if you're hedging 10%, could become 30, 40% of your portfolio. That's how much money you would make off of this. And if you're wrong, it doesn't matter because the rest of the stocks are going to go higher. It's a big deal. You hedge 5% of your portfolio, whatever it is. But pay close attention to the advice because she is by far the best I know when it comes to hedging. And that's why I hired her. I'm glad she's at Curzio Research. Anyway, just be careful out there, guys. I know there's a lot of statistics I threw at you. I know everyone likes to be entertained and stories and stuff like that. To me, this is really important. We've done incredibly well in the markets for a long time. It doesn't help me by telling you to protect yourself, right? Bull markets are probably great for financial newsletters because everybody wants to buy everything. It's easy to sell. So it's not my best interest to come on here and tell you what I'm telling you, but I'm doing that because I care, because I've been running this business for 20 years with Curzio Research. And there's times to be super bullish, which we've been for a very, very long time. And there's times to just be cautious. And now's the time to be cautious. Because again, I don't trust the Fed, and I definitely don't trust our politicians. I have a great interview today, which is being sponsored by blockchain.com. Most trusted cryptocurrency platforms in the world, over 70 million wallets, and over $800 billion in transactions since 2011. Not only can you trade your favorite cryptos on blockchain.com, but you could earn up to 13% interest annually on your crypto. That includes Bitcoin, Ethereum, stablecoins, USD, Tether. More information to start your account, go to blockchain.com. That's blockchain.com. Yes, I use them as well. And my guest this week is the one and only Chris MacIntosh. Chris, the founder of Capital Exploits, also manages money. Highly controversial, says exactly what's on his mind. You would know this if you follow him on Twitter. It's very entertaining. Chris has been coming on this podcast, I'd say, for about 6 years. Incredibly smart. He's right a lot more than he's wrong. Has given you tons of amazing ideas, including Bitcoin. I mean, he was buying at 400 Bitcoin. 400! Was it back to 55,000, around there? Did you buy junior miners in 2017, position his portfolio that way? Most recently, about 9 months ago, he told you to buy oil stocks. But the amount of homework that this guy does, just behind every one of his investments, his ideas, it's what separates him from so many other so-called analysts out there. And I've seen the research firsthand. He's made me money personally firsthand by following his idea. Yes, I listen to the guys that I interview on the podcast, as well as you should too. I vet these guys and make sure I bring great guys in front of you. Chris is one of those great guys. So enough of the build-up. Here's my interview with Chris MacIntosh. Chris MacIntosh, thanks so much for coming on Wall Street Unplugged.
Thanks for having me, Frank. It's good to be back.
Well, I have to say, good to be back. I mean, we've been doing this probably for about 3 to 4 years having you on, and some of your investments have been absolutely incredible. I would actually put you right at the top of the list in terms of getting into Bitcoin super early, getting into oil, which I didn't really agree with your thesis when you came on. I think it was about 9 months to a year ago, and you turned out to be right, and I was wrong. I just thought it was a little early, but just finding those assets at a mispriced, favorable risk rewards, asymmetric investing is really cool. But I want to start off with this. So when are you planning on getting the vaccine so you could travel?
Oh, well, at the moment, I'm just sitting here waiting for my overlords to tell me when I can take some experimental DNA-enhancing vaccine. And I eagerly await them plunging it into my arm on a continuous basis, because getting it once will not be enough. So I'm just waiting, really.
You know, it's funny and it's not funny, right? Because this is probably going to happen where we're going to have to get vaccinated and carry a card around to actually, I know there's some states that DeSantis said you don't have to do that in Florida, but other states I think are going to mandate it. And especially other countries like Canada, I could see that, which I travel a lot to for mining and stuff. But more to the point, we all have our personal feelings, whether we agree or disagree, but this also creates different opportunities, investment opportunities. What are some of the things that you're seeing? Because I saw you comment, and guys, you got to follow Chris on Twitter. It's very, very entertaining with Capital Exploits. I saw you mention how ARK and Cathie Wood are continuing to invest in these growth stocks and playing for deflation, but you're going to take the opposite end of that coin. What are some of the things that are opening up because of you're seeing, with the vaccine gets distributed, travel industry, again, it's creating opportunities, and I want to put politics and personal feelings aside, but how are you using that to find investment opportunities?
Well, I think if we just go on 40,000 foot view, what we're experiencing is a breakdown of the international rules-based system that has existed post-Bretton Woods. There's a number of components to that. Deglobalization is one of them. Another one is a shift of political, economic, and human capital or intellectual capital from the West to the East. This has been taking place at an increasing trend. It's been an increasing trend for the last, let's say, 10, 15 years. And it's one of the reasons we moved out to this sort of region of the world, but it's now going in through an absolute acceleration phase. So that's kind of the global setup that we find ourselves in, and what it's providing us is we're at a pivotal point where a lot of the trends and a lot of the investments that have succeeded over the last, I would say, even 40 years, but certainly over the last 10, 15 years, that had reached astronomical levels, are changing. The dynamics behind them are changing. So, for example, I talk about Cathie Wood. So Cathie has gotten into all of these growth equities. She's throwing out numbers like $3,000 for Tesla per share. And none of the companies, or many of the companies that she's investing in, make any money. Profitability doesn't matter anymore. Now, I come at this from actually having seen a lot of what is transpiring in that space. But earlier on in the cycle, if you remember, I built a venture capital firm for the very reason that I figured out, or I believed at the time, that we were going to have an enormous amount of capital shift into risk growth, quote unquote, growth assets. The furthest end of the risk curve is venture capital, and that's where I went to. That became really, really stupid in 2016, 2017. I sold the business in mid-2016. It got even worse, and we will all remember WeWork and the elevating the world's consciousness and all this kind of nonsense, when really all it was a Regis. You just subleased bloody buildings. There's nothing fantastic about it. It's a low margin business. It's an okay business, but it's nothing that's elevating anybody's bloody consciousness. But people bought into that nonsense, and we had these ridiculous valuations that all collapsed. So that whole private equity venture capital space has come under a lot of pressure. But we're seeing this tail end of that speculative mania, and we're seeing it in listed equities. Much of that is driven by both algos and essentially the same thing, which is passive investment capital. So we've had this extraordinary amount of capital that's shifted into non-managed or passively managed indices, and there's a feedback loop there whereby the more capital that goes in, the more it sucks in more capital. In other words, for example, you can run an algo, and the algos will be saying, you know what, if this part of the index goes up by 2%, allocate another 2% of capital to it. And by virtue of allocating another 2% of your capital in AUM to that particular sector, it causes the sector to rise more, which then says, hey, if it's now increased by 4%, allocate another 1%, or whatever the case might be. this kind of feedback loop, which is why we're getting today. We have the top 5 companies in the S&P account for roughly 25% of the index. We've never ever had such extraordinary concentration. If you go back and you remember in the GFC, we had similar dynamics, but it wasn't anywhere near as high as 25%, and that was enough to tip the whole card over. The point is, we don't know when that tip happens, but we do know that it's extraordinary. We do know that it doesn't make any sense. We do know that the valuations that are being paid for a lot of these companies are mathematically, impossible for them to actually, unless every other company sort of goes away on the earth and they land up, capturing not just their own segment of the market, but many other markets that don't make any sense. And so the probability of these things working out in the medium to long term for investors is super problematic. While all of this is taking place, we're having this extraordinary supply destruction. And you've got supply destruction in critical goods, while at the same time you have monetary expansion, fiscal policies that are coming in, both of which are extraordinarily destructive to the value of currency. And so I believe we've already seen the first innings of this shift. If you look at when we last spoke, we talked about oil. Okay, so oil is one of the components behind this, but you've got the amount of capital that is now going into value stocks as opposed to growth. That turning point has already we believe it's been hit. It's going to be bumpy. It can come back down again, but we are confident that secular and cyclical change has taken place. And where people are missing this is they're looking and they're saying, in order for us to have capital go back into value and to go back into commodities, we have to see growth. Because the last time we've ever experienced bull markets in commodities, for example, has been as a consequence of growth. It's been emerging market growth. It's been the rise of Asia. It's the BRICS, etc. Mm-hmm. This time, that's not happening. But this time, we're going to have an extraordinary bull market in these as a consequence of supply destruction, not as a consequence of demand-led growth. And so everyone's looking at the growth and going, the world's shut down, and there's many people have gone out of business. There's less growth. I get it. I get all of that. But what you've had is more supply destruction than you have of growth. And it's all taken place at the very tail end of what was a pretty bloody brutal commodity bear market. So that sets us up for a phenomenal next decade, I would say. And anyway, so that's kind of, I'm just rabbiting on. That's the broad.
No, I love it. I love the explanation. I love the explanation of that. So let's get into the commodity part. And also, we'll throw Bitcoin in there as well. I want to share something, and maybe we can start with Bitcoin before we get into gold and oil and different commodities and stuff, which I know you've been invested in and doing very well on. But on your website here, Capital Exploits, guys, just scroll down here to your blog, and you have something interesting here. So it's 13 reasons bulls are wrong. Now, I want to bring everyone in here before I say anything.
Got a bunch of hate mail for that.
No. But you are not a perma-bull or a perma-bear. It's one of the things I love about you, because when the facts change, you change. Where we don't see that a lot. We don't see it often, especially with gold bugs. It's buy gold no matter what the market is. You were one of the early adopters of Bitcoin. You still own Bitcoin now. I mean, you're talking about 2014, and I don't think you've sold any, if I read that correctly. So you're just pointing out, hey, why Bitcoin could go to 100,000, but here's some serious risks, because when you see things at all-time highs, people kind of forget the risks, and you're a guy that always looks at the risks. I believe you look at the risks first, and making sure that they're manageable and that reward is going to be that much greater, right? Risk reward, asymmetric investing. But talk about that story on Bitcoin. And I don't want it to be where, hey, you're going to get hate email, because you've been right, you've been bullish on this, and you still own it. But to me, I read this piece as someone that really knows this industry that's saying, hey, just be careful here. It's getting, a little crazy.
So Bitcoin's been one of those things. look, it's easily been the most asymmetrical investment I've had, and I've had a bunch. So we ran an event where we got investors into it. I was still really trying to figure it out, but I had sufficient. We had sufficient information at the time that led us to believe that it was a decent risk reward bet. Okay, and it was about $450. So we treated it like you would treat any other venture capital type of investment, where you say, you know what, there's a good probability this thing goes to zero and it doesn't work out. So I'm going to risk, my weighted investment is going to be risk adjusted for that probability event. And then as things transpire, well, we know where we're at now. And the other thing that I've been waiting, the main thing that I've been waiting for, because like I rode it all the way up to 20, I let it crash back down, and I didn't sell, I didn't do anything. I added more, a little bit more when it dropped down to like 4, and then at about 6.5, I added some more. But anyway, the long and short of it is most markets go through cycles. In terms of new technologies, if you will, ordinarily what happens is capital will go into a sector via family and friends, and it's a bunch of kids in hoodies drinking beer in their garage, making whatever it is that they're making. And so they ask mum and dad for some money, and then friends come in, and you kind of slowly build this up until you have something, and then you have angel groups will come in and invest into that technology or that sector, and then once you get more traction, often liquidity events in that larger companies will buy out these smaller companies in whatever the new technology is. And now you have some liquidity events, you kind of have traction, you can see the runway. That's when the venture capitalists start coming in. So the VC firms will come in, they start putting money in. And then you get a few liquidity events, either in the VC world where they're selling them to other funds, and or where they're actually getting listed and they're actually becoming public. And then as soon as you get some of them going public, now you have the brokers come in, and the brokers go, okay, cool, I can start selling this to my retail client base. Or if it's IPOs, then they'll sell it to their accredited client base. So now you kind of got broker participation, and the bull builds and builds. And the sort of tail end of that is when the investment bankers look at it and they go, hey, we've got a whole new asset class here. It's a whole new sector. Let's go and make some money, because at the end of the day, they'll sell anything. They don't give a shit. So now they'll take this new asset class and they'll package it up, right? And that's when you'll get indices or you'll get ETFs, right? So you'll have a new ETF that's listed and it's for solar or it's for whatever, okay? And what they're doing now is they're just making it super easy for the retail investor to come in and go, I want that. I've seen that that's done really well over the last 10, 15 years or whatever it is. This is clearly that I have to be involved. Here's an easy way for me. Click of a button on my Robinhood account and I can buy it. That is often the tail end of that particular bull. Because who's going to sell? Who else is there to sell to? So that whole transition takes place regularly and all sorts of things. Now with Bitcoin, what we actually had was we missed the entire corporate component in the last, when it ran to 20,000. The reason I didn't sell and I remained bullish, I looked at it, I was like, I understand charts. I'm like, this is nuts. And I expected volatility, and I actually didn't expect it to crash as much as it did, but hey, whatever. I was like, this is a massively volatile asset class. But what I wanted to see was institutional participation, because we didn't have it yet. We had retail participation, but predominantly actually from like a select niche group. It wasn't broad retail participation. Everyone was like, after it ran to 20,000, a lot of people were like, oh, well, every joker and the shoemaker was buying Bitcoin, and that's bullshit. It wasn't actually that extensive. Part of it is just the free float of Bitcoin is so tiny. So you had retail participation, but not broad retail guys with a Robinhood account participation. So that whole retail component had not taken place. And commercial or institutional participation hadn't taken place at all. So that's now happening. That's what we were waiting for. That can easily run a bunch, and can it go 10x from here? Possibly. But the points that I made in that blog post, I think, are all relevant. There is this, while that's taking place, central banks have a huge issue. They have to resolve their debt, which is unsustainable, unpayable, and they are increasingly owning much, much more of the bond market. We've seen this. Japan basically owns all the bond market. There is no functioning bond market in Japan. Europe, there's increasingly no functioning bond market in Europe because 100% of all secondary issuance is bought by the central bank and about 85% of first issuance. So that's not a participating market. So the reflective interest rates are incorrect. They're completely mispriced. So, and they're going to have to keep doing that to the extent where they're just going to own the entire bond market, and it's just Peter playing Paul. It's a nonsense story. So they realize that that's not going to get them anywhere, and ultimately the mispricing of real interest rates, the market starts pricing them anyway. I mean, for example, when you look at ECB rates, if you look at the German bonds or anything else, and you go out and you want to borrow money to start your business, you're not paying those rates. You're not paying anywhere near those rates. So the disconnect gets broader and worse. Now, so the answer for these pointy shoe bureaucrats is to actually repudiate that debt and to issue or usher in a new central bank digital currency. When that happens, they will not want to have any conduits to get out. In other words, because what it is essentially, Frank, is capital controls. If you think about how we've got capital controls in the third world, they shut down the borders, right? And they won't let you cross the border with a bag of money. That's their level of capital control. They don't need to do that anymore. Everything's digital. So they've got to do the same thing in the digital world. So in the digital world, they don't want you to have an ability to escape their new system. And Bitcoin is an escape valve, which makes it kind of asymmetric, because as they look to bringing that in, there would conceivably be a lot of people who go, holy shit, I don't trust this new central bank digital currency that's being issued. I don't want my cash being converted into that thing. And I'm out. And so I'm going to choose other avenues. And there could be many, many avenues. It could be buying gold, it could be buying oil, whatever. But one of those avenues certainly is Bitcoin. And I don't think it's reasonable to expect them to allow that. And so while I'm aware that you can't ban it per se, you can easily ban people using it. And if you think that people are going to repudiate that and say, well, no, I'm going to do it anyway, then you haven't been looking at the world over the last year, because they just told you to lock yourself under your pillow for what clearly, evidently now is not much worse than a seasonal flu, to wear double masks, to take experimental drugs into your body, and people are doing it. So to think that people wouldn't turn around and say, no, I'm going to actually use Bitcoin and the hell with you, I think is flies in the face of the evidence of what we've seen over the last year. So that actually has made me far more bearish. If we'd seen a different response to these tyrannical, draconian measures being taken, then one could think that humanity actually had some sense, and we could have a way forward with some, it doesn't even need to be Bitcoin, but any other sort of free, decentralized monetary system. But at this point in time, that doesn't, unfortunately, tie in with what's taking place.
No, that makes a lot of sense. And I love that, because everyone right now is really bullish on Bitcoin. And it's just nice to see someone who's been bullish on it saying, hey, just there's things to worry about here, and just the government and things like that. That there are definitely risks to it. Everyone's just like, it's going to 100,000 more institutional adoption. But one of the areas that has, I don't know if it's because, people choose between Bitcoin or gold, but I would think from your standpoint, in a market where you're seeing inflated valuations almost in every single sector, right? Even the so-called value growth, transition from growth into value and all these reopen trades, where the cruises are trading at higher valuations than they were pre-COVID, and they still don't have any ships in the water yet, the three biggest ones. I would think gold here. I remember you coming on the podcast, I think it was 2017, you said, look, we're investing heavily for credit investors in junior miners, and they surged off their lows. But over the past year, they significantly underperformed the market. Not just juniors, but we look at even the majors, right, in gold. So is this up your alley where, to me, when I look at gold, I like buying things that are hated. Everybody hates gold. Nobody wants to talk about it. You can't sell anything gold related. But I think people don't understand that last year, 2020, they reported record profits. So you're seeing growth. We're not just buying value and hopefully growth's you're seeing it. I mean, the margins that they have, the growth that they have is incredible. Yet it still seems like this is an industry that's relatively cheap, especially from the majors and the producers. But is this something that you're looking to invest in? Does this check off all your boxes in terms of, your investment style, which is, hey, we need to see, massive rewards here while taking on as low risk as possible?
Yeah, I mean, look, everything goes through, again, we're at the first innings of this major super cycle in commodities. And so it's not going to be linear. Don't expect it to be linear. And the smart thing to do is actually just to be very patient, not get overly excited with anything, build a portfolio that has multiple positions across multiple sectors, and literally be right and sit tight. Now, I know that's boring for most people. Much of what we do, my positioning for the last 12 months, 2 years, hasn't changed a whole lot. It's changed a little bit, but broadly, we don't churn our portfolio very much. We don't dive in and out of things. You be right, you sit tight. You keep analyzing what you hold. If you're holding it and it doesn't make sense to hold it any longer, you get rid of it and you either replace it with something that's a better asset, or you reallocate into another sector that might have more asymmetry. But by and large, you don't do a hell of a lot. With respect to gold, we're having a bit of a pullback. And look, we could have a short-term liquidity event. This is the biggest risk. And a lot of clients will come to me and say, wow, I'm really worried about the market. Should I wait and maybe we dive in, after some sort of crash? And my response to that is always the same. What is the crash? If we get a crash, and it's not given that we will, what does it look like? Is it a crash in bonds? Is it a crash in bonds and equities? Is it a crash in, what is it a crash in? Because remember, when something's crashing out, it's got to crash against something else. In other words, an equity market crash is actually just a bull market in the dollar, or vice versa, right? Or some other currency, because what's crashing against? What's crashing against currency? So then I would ask the question, if you're worried about a crash in the equity markets, and again, this is a broad equities, we're not in the broad equity market. We don't own the S&P. We don't own the NASDAQ. We're very, very select on what we do own. But if you're that guy and you've got broad mutual fund exposures to a bunch of the indices, you're looking at it and you're saying, okay, I'm scared of a crash. Well, here's the second question. If you want to get out and go into cash, how long are you going to own the cash for? Because we've just had roughly $4 trillion just in the United States alone. That's stimulus package, which is roughly 40% of the existing feds balance sheet. Would you want to own cash when that's taking place? That doesn't inspire me with confidence to want to own dollars or to want to own bonds, which is ordinarily in some crash you would own bonds because they would outperform your equity positions. So, when you look at what you can invest in, there's a huge problem here. On a long, our time frame is 5-10 years. what happens in the next 6 months, I don't know, and I don't really care too much. When I look out 5 years, it's much more clear and much more evident to me where we're going. And I need to be positioned for that, because that's critical for me. It's critical for me, it's critical for my family, it's critical for my clients. So when I look at that, I'm like, I don't want to own dollars. I don't want to own euro. I don't want to own any of this garbage. It doesn't make any sense to me. Aside from the fact that the euro looks like it's going to be replaced with some digital central bank currency, and almost certainly what they'll do is what they did when they introduced the euro, and a bunch of the countries actually just got hosed. If you were in Portugal and you suddenly went to the euro, you found that a lot of the things that you were going to go and buy on the street was actually cost more expensive, because they actually just they did a semi-Nixon on you. In any event, you don't want to own cash. You don't want to own bonds when we're at 5,000-year lows in interest rates, the highest debt levels the world has ever seen. Buying into that makes no sense to me. So you say, well, broad equities? No, I don't own that either, because you've got, again, S&P, 25% of the S&P is a bunch of companies, top tech companies, which are running at valuations that make blood want to shoot from my eyes. So it actually becomes quite easy for me to look and say, well, the stuff that I want to own is actually all this deep value, cheap stuff. And incidentally, it happens to be the very goods and services that are pretty much critical to humanity, whether it be copper, nickel, natural gas, coal, and from the precious metal sides of things, gold, silver, all of those fit into a broad portfolio. So, you asked specifically about gold stocks. I'm not worried about them. I expect that they'll have some volatility, but I'm going to hold them for the next probably 5-10 years. We'll see kind of how that cycle goes. So don't hold me to that, but broadly, that's what I'm thinking at this point in time.
No, it's interesting.
And there's some exceptional value out there, because the supply, again, we're coming out of a bear market in commodities, and you and I both know this. Mm-hmm. This is a super capital intensive business. It's also predicated a lot on investor emotions, and in those investor emotions for the last 15 years, or in 2012 was kind of the end of the last cycle. Nobody's wanted to go near this stuff. Now that's changed in the last 2 years. It slowly started changing. 2019, 2020. It's now. You're now at a point where, if you're getting into, for example, into private placements, you got to fight. You got to fight a bit to get placements. That was not like 2 years ago. You could name your price. You could do whatever the hell you please, because these poor guys could not get financing at all. So again, we're first innings in this phase, but there's no broad participation. And again, we're going to forget about retail, because they don't matter that much, but we're going to get institutional ownership coming in, where they're going to, they're just going to bid these things up, and there's so few assets left.
So one asset that you didn't mention, which I know that you've liked for a while, is uranium. All of a sudden, uranium has been, the trade. Everybody loves it, right? They hated it when it was really cheap, a lot of these stocks. But now you're seeing supply-demand imbalances, things that you cited, things like Michael Alkin cited, some of the brilliant minds in this industry. Now you're seeing some of these stocks move incredibly higher, and I still feel like it's under the radar. You're not hearing uranium mentioned at all in the financial media, right? You see it on social media from uranium bugs and stuff like that. Where are your thoughts on this, and could we still continue to see a lot of these stocks move higher, where the surprise for me, and what we saw at oil, right? Oil prices rose incredibly, right? So that's an influence in those stock prices, and eventually profits for those that are producing. But prices haven't really been moving higher in uranium. Does that make you nervous, or you think, hey, that's got to come based on a supply-demand imbalance by so many countries and so many companies just cutting off production, and with demand really coming online now for alternative energies and green fuel, especially international? I want to get your thoughts right now today, as someone who's done very well in the uranium market. Do you still think this trend has legs?
We're still long. First innings in it. The dynamics of that market, if we strip out the greenwashing, which is what I call it, because renewable green energy is both, when you look at the dynamics of it, is it's neither green nor is it renewable for the most part. That aside, we're going to still play this game. Politicians are still going to pretend that it is what it isn't, and we're still going to have an extraordinary boom. That dynamic did not exist in the previous bull market in uranium. So there wasn't the pressures towards a green economy, and yet we saw multiples of what we've already seen. So our positions were up about 800, I think it's about 800%, somewhere there. But if you go and you have a look for market cap adjusted, the companies that we've got in our portfolio, but you could take pretty much any. You just go and get a string of uranium companies and track them on a market cap adjusted basis, and you'll see we've hardly moved in this. We really have hardly moved. The reason that you can go up 800% and really actually hardly moved is because they were absolutely decimated. We've got roughly 90% of the companies that existed in the previous bull went away. They're gone. So the supply side got crushed. And again, this time around, we've actually got a demand side that is really extraordinary because it's being led by this green initiative, renewable energy bollocks. And so that's going to push a lot more capital into the uranium space. That's just one component. Then the other component that you've got is actually within Asia in particular, India, China as well. The amount of capital that's going in and the amount of reactors being built and everything else dwarfs anything that we've seen before. So I do think that we have an extraordinary setup. I mean, the best time, I guess, was to invest, 18 months ago, when it was still, in fact, the best time to invest was in March when we had that initial sell-off, or the Corona sell-off, and I have the
uranium ETF up here that I'm showing while you're talking, just overall ETF, but just to show the huge growth. But again,
is that URNM?
This is just URA. So I just brought up some just to see a broad range of how good this trade has been, especially over the past year, which again not too many people are talking about, right, Chris?
Well, just on that note, because that's a garbage ETF. It's a horrible thing. There's another one that's been listed called URNM that I would suggest listeners go and have a look at. What happened with URA was and this is interesting to watch with cycles. Look, ETF providers make money based on volume, and they make money based on assets under management in that ETF, and they clip the ticket. So you pay 50 basis points or 28 basis points, whatever it is, depending on the ETF structure. But by and large, they need to have a lot of capital into that structure. So the individual equities that got hammered in what was URA meant that the amount of your capitalization was so small. So these guys weren't making much money. What they did was they went and changed the structure of URA, and they started throwing in a bunch of companies which actually aren't really uranium companies, but they had larger market caps. So you could chuck in something like Mitsubishi because it has some freaking R&D department that's got some uranium component or whatever. Anyway, so they threw in a whole lot of stuff that was not really specifically uranium related, but it allowed the market cap to be greater, and hence they could earn more fees. So you've got to be careful with that. But that's actually a really good indicator of what you get at the bottom of a cycle, right? When they either delist an ETF because it just doesn't make sense for them to own it anymore, like they did with SEA, which is shipping, another one of our sectors. They delisted it. They're like, oh, fuck it, no one's interested in shipping. We're not going to need ships anymore. And so they just delisted the damn thing. So now you actually can't get exposure to shipping without going and buying individual equities. That's great. That's a good thing. It just means that there's less participants there. Anyway, back to uranium. So with uranium, that whole ETF is garbage. There's a new one that just got listed called URNM, which is a better proxy for uranium if investors the desire to go after it. But you'll see the same sort of thing. I mean, you're not going to get the price history on Uranium because it's only just been listed. But I mean, look, you could just take Cameco if you want to kind of Cameco tracks uranium spot relatively well. So if you're kind of trying to get your head around from a 40,000 foot view, what does the uranium market look like? I'd use Cameco as a proxy. And then if you want exposure and you don't have the skills or don't want to go and pick individual equities, I would go for URNM as opposed to URA. But no, I think the sector is going to continue to do well. For all of the reasons that the entire base commodity sector is going to do well, but especially as a consequence of green funds, if you want to call them that, that are going to come out and they're going to invest into the space. And now what you're seeing is some of the companies are going out and buying ahead in the spot market because they're realizing, oh shit, we don't have supply. And so that's an interesting change. I read about, I think it was last week or the week before in one of our notes to clients. But yeah, we're long, we remain long. I anticipate we'll be long for a few years. We'll watch and keep our eye on it. But
now, Chris, when you say you're long, is it through North Shore Global Uranium? Is it through individual companies? Is it through private placements? Is it Cameco? Is it NextGen, UEC? Uranium Royalty, which is a new royalty company in uranium. I mean, when you say long, is there any specific ideas that you could share? And if you can't, I understand 100%. But just for some of our listeners out there, when you say you're long, what are some of the good investments out there? Is it you're long just the price of uranium and maybe play it that way through the options market? I'm just curious how, where do you see, the separation in companies?
Sure. Yeah. Look, for starters, we don't use leverage. Very, very rarely do we use leverage. So, options, we'd never do futures contracts. If you think, and this goes back to, look, we're deep value investors, but if you go and you look at long-term cycles, sure, your futures traders can do well, but like for your average Joe, the best thing that you can do is just bang, you hit that sector and you just hold on for the ride, and you want to get at least 80% of that ride. You want to get the meat of it. And when things get nutty, start sort of tapering off and realize, and I'm not very good at this, but realize that things are going to get even more stupid than you think they will. So when you're looking at stuff, that doesn't make any sense. It can easily double or triple from there. But the risk behind it, of course, is you need to be cognizant of risk. So anyway, and to a certain extent, that's what I feel like Bitcoin's a little bit like now, right? I mean, we're up an astonishing amount, but let's say we weren't. Let's say we got in at, I don't know, 6,000, which is not that long ago, right? You're still up like 10 times, right? So you got to look at it and go, okay, if I took that capital now, where can I get a 10 times return? Is it in Bitcoin? Or would I go and buy nickel miners, where we're going to need, by all accounts, at least at the very minimum 4 times global supply to meet the initiatives of many Western governments in terms of their 2030 protocols of green energy. So everything's like kind of looking at it as a broad perspective and going, don't look at it in isolation. And I think that's one of the problems that you have with gold bugs or Bitcoin bugs or whatever, is they kind of live in their little isolated world and they get fixated on that one thing. It's a bit like a teenager with a girlfriend, and you can only see that girlfriend, and she's probably a pain in the ass, but it's like there's other girls out there. Have a look around. But anyway, on uranium, look, the way that we go about this, Frank, is quite simple. We want to get exposure to a sector. We're cognizant that you can pick the best company, but some things can go wrong. Remember Cameco's Cigar Lake flooding. It was a good company. Could you have foreseen that? know. Even the guys who were working on the bloody project didn't foresee it, obviously, right? And so there's all sorts of things that can take place. It could be geopolitical risk. You could have a war breakout. You could have government regulations that come in. There's a lot of different things that can upset what would ordinarily be a very, very good investment. And so we like to have a broad diversification. We basically look at that and we say, okay, let's break that down. Let's take our uranium sector allocation. We want to have roughly 50% of that in companies that we don't think are going to go away, right? So these are your Camicos. Or the ETF that I mentioned, Uranium, kind of gives you broad exposure. And then the balance of that, we will go and look and say, okay, what else could we put in here? And we'll get geographically diversified, and we might take risk in that we'll go into companies which might have a resource that is not yet developed, right? So it's in-ground resource. We know the resource is there. Maybe they balance. Maybe they've got 3 years of cash in the balance sheet to go, okay. But where that resource, if it comes into the money, is now very valuable, and the share price would reflect it. So you can have something that goes from 10 cents to like $5, but you're taking risk. So we kind of break that down. Ordinarily, we won't take any one position. That's like, we're often 1% of AUM on an individual position. So it's not so much about it is what you pick, but it's about risk management. It's about portfolio management. That's what people need to do better, I think. But I could throw out all sorts of names. Energy fuels, I think, is a good one, which tickers UUU. Or is it? I think it's 4 U's. Anyway,
I think it is 4 U's.
Get that mixed up. Yes, UUU. We own Bannerman. Bannerman's probably got the best management team, and I can think of, like, great CEO. Their resources is not amazing, but I've never seen. Look, I've seen amazing resources run by shitty management teams and they don't work, and I've seen average resources run by amazing management teams and they work. People are important. Yeah. What else? Paladin we own, Boss Resources. You could, but look, again, if you're just trying to get broad exposure, that new ETF Uranium, I think, is a decent proxy to get into that space. There's some other ones that we own that you can have a look at.
No, that's great stuff. Thank you so much. Thanks so much for sharing those ideas too. So I know you've been early in that trend, just like a lot of other trends. I know you made my investors a lot of money. So I really appreciate you coming on the podcast. If someone wants to learn more about you, you go to your website or follow you on Twitter. How could they do that?
Yeah, you can. I'm less active on Twitter these days than I have been in the past. The hell with the Silicon Valley overlords. I've gone off Facebook. I've de-Googled everything, and Twitter sort of still hangs out there. But no, direct on my website, capitalistexploits.at, and occasionally probably write a bit less than I used to on the free blog. Just very, very busy these days. There, or Glenhawkey Capital, but that's just for accredited investors. And that's we do privately, personally managed accounts for people, but which is actually just our portfolio mirrored. Yeah. So that's how you can find me.
That's great stuff, Chris. And again, I really appreciate you coming on from New Zealand. Like I said, we always I don't know exactly if you're always in New Zealand when we do these, but I know there's a big time difference in terms of it's a different day. So sometimes you get a little confused with timing and stuff, but I really appreciate you doing this, and you've done a hell of a job for my investors. You always come on, you always bring it. And I really, really appreciate that, man, more than you know. So thank you so much for coming on and giving these guys ideas, and more important, giving them ideas where they've made money on, because that's what this podcast is about. So I appreciate it, buddy.
You're welcome. It's always good to see you and good to chat. And, it'll be awesome to actually do one of these in person, but
hopefully soon.
that's looking like it's it's a problematic scenario ahead of us. So we'll have to just see how that one pans out.
No, absolutely. Absolutely. So, all right. Thank you again for coming on, and we'll talk soon.
Take care, mate. See ya.
Great stuff from Chris. Sure to go to our Curzio Research YouTube page to watch that video for this interview and all my podcasts. I mean, it's really, really cool. Put up some charts and figures and stuff like that. So everything is done in video format at our studio. A lot of work goes behind it, but getting very, very positive reviews. Again, that's absolutely for free. It's just a way to watch it other than iTunes, which I know some of you to work out, listen to this is perfectly fine. But if you'd like to watch it, Curzio Research YouTube page, be sure to go there, subscribe. But Chris, always full of good ideas. And he has a system, right? Asymmetric, which, he's buying things that are hated that he expects that will re-rate in the future. So I always love talking to him. Great ideas all the time and very, very smart. I know he's made you guys a lot of money. He's made me money, and I love having him on. But this podcast is about you, not about me. Let me know what you thought. Frank, CurzioResearch.com. That's Frank at CurzioResearch.com. Now let's bring in Daniel Creech, Senior Analyst at Curzio Research. Daniel, what's going on, buddy?
Frank, happy Wednesday. Lots to go over today. It's exciting. Earnings season's kicking off. So, yeah,
I mean,
a lot of fun.
I love earnings season. It's because after earnings season's over, it's like there's no news. And then they just have like if you're watching CNBC or Fox, whatever you watch, it's, they have to inflate some story to make you watch it. But earnings is actually really cool news going on. And that's where I find the most ideas too, because it's not just the companies that are reporting, right? Then it's just what they're saying in the conference calls, which I mentioned earlier, that are huge, that could lead to more and more ideas. So
yeah, absolutely. I mean, like UPS, I mean, they're just, even though they didn't give guidance again, but they basically just said, hey, we expect demand to be huge for the foreseeable future. It's like, oh, okay. Huge stock pops, what, 7-11%?
Yeah.
Right after earnings?
Yeah.
Them and FedEx. I don't know how much you touched on it in the past, but we were talking off camera, yesterday, day before. Mm-hmm. You talk about a follow through from COVID and people adjusting. A lot of things will go back to normal. Things are opening up. Hopefully people get, comfortable with going back and saying hello to one another. But there's certain things you're going to do and order online that you may not go back to the old way, and that's going to benefit them. I know Amazon's getting in the shipping business, but hard materials like that and your everyday needs and necessities are great. Waste management reported strong earnings. They're going to grow. Everybody needs their trash taken out, and they're going to grow 12.5% to 13%, give or take, over the next year. Mm-hmm. Steady. I mean, staples are going to be great, man.
Yeah, it's you mentioned too that we did talk offline about this, where the stay-at-home stocks. Now, a lot of them did fantastic. You look at Peloton, and Peloton, I think a lot of people are going to be canceling that membership. You've seen the stock come down a little bit. There's some, whatever problems with the treadmill or whatever, safety concerns. I'm not worried about that. I just think a lot of people are going to be like, okay, now I can go outside. I don't have to pay $40 a month for their service, especially when Apple has a similar service where you could pay, I think, $9. Zoom as well as another company, as others as stay at home. You're going to see business slow down as the economy opens. But with UPS, what you mentioned is interesting because they're not going to see a slowdown because there's a large percent. I mean, I think it was 8% of people do spend money on digital advertising, right? It's like 8% of the market compared, not digital advertising, but through the internet. That's how much they spend, right? In retail. That went up tremendously, right, with COVID because you need to get everything delivered. Now, people never used Amazon for that. People, they familiar with Amazon. Yes, they have that. They never really used it to the point where I can get my paper towels delivered. I can get toilet paper delivered every month, constant. And now that you're on that plane, you're not going to come off it because it's so easy, right? I mean, so you're looking at Amazon. It's going to continue to be a beneficiary. And I think you're going to see that come out with their estimates. And I don't think you're going to see a slowdown at all from the reopening trade, which you're going to see in some of these companies. I think it's going to benefit UPS tremendously. Yeah,
like I said, that's hard to argue. Obviously, they just posted a great quarter. Stock's reacting well. The funny thing on Amazon is a league of their own. They can do whatever. They can come out and say whatever they want. They could probably come out and say they're going to get out of the online shopping business and the stock will go up. I mean, they're just doing everything right. Yeah. They can infiltrate any market they want. It's incredible. It's good to see them. They're actually playing this politically correctness and fun game in the stock market because, the rumor is when they announce earnings coming up, it might be Thursday. I should know that. That's my fault. Unprofessional. But there's rumors out there they're going to announce a stock split. And the stock has been moving higher towards $3,500 a share on the news that, hey, because why? Because people mentally like to buy cheaper, quote unquote, smaller dollar amount stocks. So if it goes from $3,500 to say under $1,000 or even a couple hundred or whatever, you're going to see retail investors bid it up because it's cheaper all of a sudden mentally. And that's okay. That's good for Curzio Research Advisory. That's a big holding for us. But it's just kind of funny to see Bezos step away and then them kind of announce this. And, nothing's a coincidence in the stock market, just like politics. So,
yeah, pretty much. I could tell you too, Dan, that I mean, Google came out with earnings just today. Holy cow, right? I mean, the numbers are, and I mentioned them earlier, $26 in earnings, right? $26.30 in earnings, and that's $10 better than consensus estimates. Now, I want to put that in perspective for everyone because you've seen the stock run up higher, and it's trading at. Let me see right here. I can pull it up for you guys. Where you've seen this stock trade at over 2,400 now. Right, so new highs over 2,400. It's trading, and people say, "Oh, I missed it." At $26 in earnings, guys, which nobody again. The consensus estimate is basically the mean estimate of all the analysts. Which, if I had to guess, more than 30, probably 35, 40 cover them, and sell side analysts like Goldman Sachs, JP Morgan. It blew them out by more than $10. Right, so if you take that. And how do you figure out a PE ratio? It's very simple. You take the price and just divide it by earnings, right? So you've taken that divided by earnings. They're trading at 23 times forward earnings. That's the cheapest Google traded. Even though it's trading at its all-time high, it's trading at its cheapest level in a very, very long time and much, much, much cheaper than all the rest of the FANGs. The rest of the FANGs still have to report. We'll see about where they report. Maybe those numbers are insane as well, but most of them are trading at around 30 times forward earnings. These guys are trading, if they're able to use that number, you just times it by 4. Again, it could be up or down a little bit, depends on holiday season. But these guys trade 23 times forward earnings. And YouTube ads up 50%. Google advertising revenue up 32%. I mean, imagine that being your core business is the secular growth. And everything flows through you as well as Facebook. I mean, what's Facebook's numbers going to look like, right?
Yeah, it's incredible. I mean, to know, and that's a great lesson for investors because, and I admit this, I mean, it's difficult to look at a stock like this run up and not feel like you missed it. And it's real difficult mentally and emotionally to think and argue through that, even though you're exactly right. Hey, it's very cheap here. It's cheaper than it has been in the past. It means you haven't missed the boat. That's a great lesson, and you just kind of have to jump in with both feet and gain exposure to that. So buy a little bit. If you've been waiting on something, I would at least dip your toe or jump right in and commit to whatever your long-term time frame is with something like this. Facebook is going to be good because have you followed usually, everybody's used to drama with celebrities. You can't check out of the damn grocery store and not, have a laugh because you gotta catch up on the gossip while you're waiting 6 feet behind the next person in line so you don't get arrested. Now we have CEO drama. They both report tonight, Facebook and
Apple.
Mm-hmm. Have you been following this at all with Tim Cook and
Very
Zuckerberg?
little, but I know it's like a back and forth.
Gosh, you talk about a bunch of crybaby billionaires. Holy shnikes.
Yeah, just the update and this way, I think Facebook can't track people as much, right?
So here's the funny thing. Long story short, Apple came out with a new operating software you can download on your iPads and iPhones and all that kind of stuff. And it basically, does it make you choose or does it give you the option to choose whether you want to be tracked across different apps? So Facebook's going to track you if you open up Facebook or open up something else. Mm-hmm. Maybe people aren't familiar with that. That's not here or there. So Facebook comes out and starts taking shots about Apple and this new system and how it's actually going to improve their basically skimming of your data. Mm-hmm. It's genius. I mean, you point the finger and do exactly what you accuse your opponents. It's good to see the Wall Streeters learning from politics. It's just impressive.
Politics, they're cutthroat. Those people that's
a lot of fun.
Their family members if they can get ahead. I mean, that is the most, ruthless. I mean, these people they'll shake your hand and just completely back. I mean, it's great. We've seen it, right? We've seen it in just this year in politics, and it's gotten so bad where everyone's so emotional about it. More people are involved in it than ever, especially athletes and actors, actresses, and crazy stuff like that. But yeah, it's look, when you download the apps, they want to track every single thing. It's very easy on your Apple phone to see who tracks what. But with Facebook, when you have a site like that people use for a lot of different things and local groups, and you want to find different things, even whatever in certain areas, it removes a lot of the functions, so it doesn't work as well. So it almost like forces you to do that. It forces to track you. And listen, you're getting tracked and you hate it, but that's what it is. You're the product. You should know that by now. And you want to complain about it, but what they're doing is they know exactly what you want to buy, and they're going to tell you exactly when it's on sale. That's why everything you look at on the internet, even through Google, you're going to see it pop up. If you try looking for a Dyson vacuum cleaner, just put Dyson vacuum cleaner and just look at that site. Now, everything that you pull up, every other site, those ads are all going to come up with that because they're tracking you with cookies. Everything. But so, again, which is crazy because even when you're looking at just the maps that they have, right? Whether it's Google Maps, whether it's Waze, whether it's Microsoft, they're tracking everything that you do, every single step. They know exactly where you go now. And even insurance companies, oh, well, if you put this in your car, we can lower your insurance because we could see that you drove. They don't give a shit about lowering your insurance. They want to track everything because that data is worth a fortune to them and they could sell it to anybody. So, no surprise there, right? I mean, it is what it is. And I love how people complain about it. They, instead of complaining, don't use Facebook.
Yeah.
That's probably the easy solution. But stop bitching about it because they're open with it. They're saying, we're going to steal everything and we're going to track you. We're going to put AI in it, know exactly what you're going to do tomorrow. We know exactly when you're going to go to the bathroom, when you're going to eat, everything, and what you're going to eat. If you don't like it, get off the platform and stop bitching. I mean, that's the best advice I can give.
Yeah, go to Twitter and get censored like a real person, Yeah,
I know. Can't say anything on Twitter anymore. Unless you agree just with everything that they're saying, the big agenda. But it's so funny. Just it's amazing how they just suppress people and they just take people off and I don't know. It's just that's a whole other conversation. But
hey, one more entertaining factor. There's another CEO feud going on. Have you read the Musk Bezos?
No.
All right. So
is that the space space in the contract?
Space
right?
gets a contract. SpaceX gets a contract. Bezos. I don't know if they're actually suing. I just saw some headlines and I was having fun looking at the fringe websites of all over on the financial media and. Elon's great at taking to Twitter and tweeting. He's got a massive following. Mm-hmm. And he made me laugh out loud. He says, Bezos can't get it up, parentheses, in space, LOL. So here you have multi-billionaires just throwing. I'm just telling you, it's just funny to see human nature. It doesn't matter if you're a billionaire or you're dirt poor. You're going to make funny, crude jokes towards each other. And that's just, it's kind of a dose of reality. So that's pretty hilarious.
It is hilarious. And Tesla reported earnings. Mm-hmm. And it's so funny, right? Because if you're a Tesla hater, you blasted the earnings. And if you're a Tesla lover, you love the earnings, right? But I just laugh at some of the points. I mean, you know better than I. And I'll let you start off with this because I know you're not such a Tesla Elon Musk fan, right? Is it fair to say that, Daniel?
Yeah. I have to explain this off camera to Frank every time. He thinks I hate Elon Musk, and I don't. I don't have hate in my heart, and nobody out there should either. I do think he's overrated and he's annoying, but that's from a financial perspective. I don't know him as a person, obviously. His whole tweet thing about having the funds locked up to go private was a total lie, and he just got a slap on the wrist from the SEC, which is a joke anyway. That's what really pissed me off, but I'm over it, even though it doesn't sound like it. The funny thing with Elon Musk is they reported record earnings and all this kind of stuff, but it's not from the actual car core business. It's all because they get credits for environmentally friendly credits and carbon credits and all this kind of stuff, and they made a huge chunk in Bitcoin, proving that, hey, it's liquid because Dave Portnoy, huge social media presence, Barstool Sports, called him out and said, hey, what are you guys selling Tesla for? And Elon Musk tweeted back and said, hey, we didn't sell it. We sold small percentage just to prove that it was liquid and all that kind of stuff. Elon Musk gets $11 billion stock option award. And so the critics are really going after this. And I'm going to defend this guy here. And I love this. This is from Reuters. And they quote, this must be out of the 10Q or something, because the company said it incurred a $299 million expense related to Musk's pay package, quote, driven by increase in market capitalization and new operational milestone becoming probable. So it's not because you actually achieve the results you're talking about. It's because our market cap went up. And hey, he's right. You could be a Tesla bear and you've been basically getting run over unless you shorted it recently. I think it's down off its all-time highs. But Musk put this out there. The board of directors voted on it, and he got it. So he's entitled to this. So I'm the capitalist saying, hey, good for this guy, even though, I'm not a Tesla fan.
I think it's actually about the funding, right? I mean, I think that, if I'm not mistaken, I think it was around $350 the stock, right? And he said he had funding. I don't know.
Something about that for 420 or 421.
Yeah, and he didn't have the funding. The funny thing is, wouldn't everybody have loved to fund that?
Yeah.
And now you look what his stock is, right?
Yeah.
So, but he didn't have it lined up, and you're not allowed to say that you have lined up funding that they could go private or whatever, because he didn't. But too bad he didn't, because people would be up a ton on that. Now let's break down Tesla, because you're looking at tax credits, right? So $518 million, and that's the credits, versus they were expecting $337 million. So very, very big number. Taxes much lower than expected. So it's not a clean. These are lumpy items, what we call when we look. So when they have a number, you want to look at lumpy items. I mean, they sold $101 million of Bitcoin. That estimated one analyst or two analysts that I read, it's around 22 to 25 cents in earnings from selling that. So you generated that just from selling that. So, you inflated earnings, right? Otherwise, it would have been an earnings per share miss. And that's why I said about Nike for so long, because Nike is just the best. This is how you manipulate earnings, right? Did they have to sell Bitcoin? No, but they sold it on purpose so they could really make the numbers, right? So I agree. But, and people say, well, when you look at operating profits altogether, more than half come from tax credits. And I laugh at that because people are like pissed off at that and said, whatever, Elon Musk, he's taking advantage of the system. That's exactly what you're supposed to do, right? I mean, every single car company right now is doing the same exact thing. They're making electric vehicles. They're going to have the same tax credits. If the government's going to hand you money, you do it. It's the only way alternative energy works, right? You could work some places very, very little with solar. There's a reason why they give you credits for it, because you're going to lose money if you just go, no one's going to do it. I mean, even electric vehicles. Daniel, I don't understand electric vehicles. How is the whole world going to go electric? I can't picture people. Listen, I've seen trends develop. I've seen changes. I've seen things like Uber. I've seen social media, and they always make things easier for the customer. Putting gas in your car is the easiest thing in the world. Finding a charger, and if you want to take long rides, and I've done research on this, where these things take around, 8 hours? Yeah, you get the super duper charger, but you might have it at your house. But, when you're charging it in between trips, like if I want to go down to Miami, I might not make it there, right? So it's over 300 miles from North Florida to South Florida. But are you really going to get that many people to do this, to use electric, to educate them when there's a million gas stations and it's very, very simple? I'm worried about it. Like, everyone's just assuming that's where we're going. It has to go that way. And yes, they're spending tons of money on infrastructure and, where they're going to locate these things. But you have to drive a certain way. Like, you're going to have to come off the road maybe to go, 5-10 miles out of your way. Maybe they have it on the highway, or most of them, but still. And then you're going to charge and sit there for 7, 8, 10 out, whatever it is. I mean, that's on average. Of course, there's people out there, electric vehicles, and say, well, it takes me a little bit less to charge it or whatever, based on, whatever. And battery technology is getting better. But the whole world going to this, and especially, driverless cars. I like to drive. I mean, I could see it in transportation, in public transportation, but, driverless cars, like, really? You're going to have driverless cars? You just need one little accident, whatever it is, and it's going to be amplified by 1 million. Just like if one person dies from the vaccine, it's going to be amplified by 1 million. People think it's going to happen all the time. So I don't get this. I think there's a big market, but not to the point where everything is going to go electric, or even 15, what is it, like 1.5% of the market is electric now only? But anyway, sorry, I went off a little tangent there.
This is definitely a growth story. Yeah, you Debbie Downer. Haven't you heard of the Green New Deal? Everything's taken care of, Frank. It's all going to get, infrastructure is going to get revitalized. It's fine.
Green is so good and so amazing that we have to fund the shit out of it.
There you go.
Yep, there it is.
Yeah, I mean, this is definitely a visionary. You got to take that pill to look way out and think, hey, technology is going to improve dramatically very quickly. Charging times are going to drastically drop. Mm-hmm. Ranges are going to improve so you can drive farther on a single charge. And yeah, gas stations will either be swapped out, replaced, added, built up. It's a whole infrastructure push. I think it's a huge stretch. But hey, the stock price is looking forward, and it's baking in and helping out investors so far. It's just crazy. I'm not a fan of the EV credits and all that kind of stuff, but it is what it is. And hats off to you if you've been long Tesla for any amount of time to where you're profitable. So
yeah, I mean, you can't take that out of the equation and say, well, if they didn't, they have them, right? And people say they're not going to run out. They're going to keep extending.
Oh, yeah.
Right?
I would assume so. I mean, governments could surprise you and do something intelligent, but I doubt it.
If the government was a business, and we know they can't run any business ever, right? So it's just, they don't care about operations or anything, right? They just spend money. Look at the post office, $5 billion of losses, right? Well, UPS and FedEx are going crazy. How can't the post office generate like billions and billions in revenue right now with everything going on? I bet you they're going to report a massive loss again because the government runs them. So how does the government make money? Well, they make money from taxes. Well, in fossil fuels, they're taxing the oil companies like crazy. I'm not saying, more fossil fuel, but it's nice to be energy independent. That's a pretty big deal since most of our wars are caused by that. Energy, especially, in the Middle East. But, okay, we're generating tons of revenue from this, but no, let's go this way because we think 30 years from now that, again, we heard this, like right now the Earth wasn't supposed to exist, right? According to Al Gore, right? It keeps getting pushed out. Everything's fine. Nothing is underwater. We're okay. Not saying that we don't have concerns. But now you're pushing this agenda where the only way it works is if you have credits and you tons of money. So that's more tax. So you're not bringing in tax. You're just spending more and more and more and more money. And now you're increasing that by trillions that you're going to be throwing into all this stuff. I mean, let's throw it into things that work. Let's not just throw it into anything. And it's, again, by saying this, I might get censored. I don't know. It's, you can't say anything bad about the planet. again, I think it's important. I think the EPA is one of the most important organizations, and it's the most corrupt by far, by any organization, the most corrupt, right? They just go after anybody, doesn't matter facts or whatever. And it's a shame. It's a shame that this whole industry is corrupt. This is all about politics. It's not about really saving the planet, just like the BLM movement. Same thing, right? Black Lives Matter. It doesn't. It's not about saving Black lives.
Saving the planet's going to be pretty difficult. I'm not going to lie.
Yeah, it's just amazing how the agendas change so quickly, and yeah, it's pretty nuts right now. But again, we're talking to you from our personal perspective, what we think. But at the end of the day, how do you make money off of it? And that's what we come to you at. It's how you can make money. Tesla is doing the right thing. That $518 million in credits. That's real money. That's real money. You could make fun of it. You could say, oh my God, their business, look at that. They're getting more credits than actual car sales. That's real credits. Those are real credits that they're getting. So, and you're looking at a lot of other companies that are going to do the same thing. And believe me, it is because of those tax credits. It's not because, electric vehicles, we believe in green and change the world. No, they believe in profits and they're getting free money from the government. So that's why all of them are going into this at the same time. And it's nice that Tesla beat them by about 2 to 3 years. So,
that'll
give them
help.
Credit.
Hey, real quick, speaking of saving the planet, ESG. You pointed out a couple weeks ago and several videos about how everybody on their presentation quarterly earnings puts up slides on ESG, environmental, social, governance, or governance, or whatever it is. And Archer Daniels Midland, okay, massive global company, huge footprint, does everything from shipping and raw agricultural commodity products. So it's a great way to look at inflation and prices rising over time. They had I looked at this last night. I want to say their presentation for their quarterly earnings was 51 slides. All right. Now, granted, they're huge. They're everywhere. They're in, I think they serve 200 countries and all kinds of stuff. I mean, it's amazing. But they have a nice devotion to ESG. And it's brilliant because they're going to be in the targets eventually because as food prices continue to move higher, you're going to get blamed for the discrepancy of poor people suffering versus rich people who can afford price increases. So it plays into the whole inflation theme. So put ADM is the ticker, put that on your watch list or, take a little position here because they reported solid earnings. It's marching higher. It pays a solid dividend. I think it's over 2%. And then you want to look at shipping because inflation is going to skyrocket. So look at shipping companies. Again. And we may try that with Dollar Stock Club again. I think we had some success in Nordic American tankers a little while ago.
Did. We had a very quick gain in that. And then, we kind of zipped out of that thing and shipping came down.
So to try to tie it in, we can complain and rant to you guys, but also give you some investable ideas to make money and keep the wolf away from the door.
Yeah. And speaking of money, we have the $1.8 trillion proposal to expand America, build back better. How's that the name? Build back better. There's a lot of smart guys in that party. Build back better. I mean, really? Anyway, okay, that's another argument. But build back better. 1.8 trillion. And I looked through this. You can see the president. I believe he's talking tonight, right, about this. And two things that stood out to me, Daniel, is one is the massive increase in capital gains taxes, and the other is the free college initiative because Biden says he's going to increase capital gains rate to 39.6% from 20% from those earning $1 million or more. When you throw in everything else, Obamacare tax, everything, the richest would pay 43.4% federal rate on realized investment returns. State taxes could put the combined tax bill north of 50%. Okay, I know you want to punish rich people. I know they find loopholes. I get it. I understand some corporations that are worth $100 billion plus don't pay taxes. I get all that. What do you think this is going to do? It's going to take money out of this. What happens with that money? I mean, you can say, it goes to their pockets and they buy more. No, it goes into hiring more people. It goes into more CapEx spend. It goes into more buybacks and dividends, which gets the investors. Which is very favorable for investors. You're taking that out of a market where you're raising taxes, you're seeing inflation start running wild. I mean, there's a lot of risks out there. I just think if that's really the number, holy cow, that scares the crap out of me. And that's just at the capital gains tax. The free college, and what is it, $100 billion to cover 2 years of tuition free. It's a community college and a bunch of grants and stuff like that. Why do they continue to use the word free? I mean, is it these colleges are going to not charge tuition? Is that the case? Because then it's free. But these guys, you know what's going to happen, right? These guys are going to raise, if they're getting it for what they're going to do, right? They say for free. It doesn't mean colleges are not going to charge you anymore. There's absolutely no way it's going to happen. What is it? The student loan debt is $1.5 trillion, been going up. I mean, if they pass the free college shit, what's going to happen? It's going to balloon to 2x or 3x. Think healthcare. The reason why healthcare is a massive, massive drain is because these guys can charge whatever they want with no competition. What do you think these guys are going to do? They're already charging you for not going to school, right? You look at Harvard, look at all these colleges. Just look at the tuition rate. Holy shit! If you see, guys, just pull up a chart. I think I had something here. Maybe I could show it to you if you're watching this on YouTube. If I still have it, I'm not sure, but it's unbelievable. I mean, you're looking at here it is, rising costs right here. So I have it here, rising college costs, average tuition fees adjusted for inflation since the 70s, and private non-profit 4-year is now close to 40 grand. I mean, it's rising at what, 3x inflation? The public 4-year is 10 grand, but these, they keep going higher and higher and higher. What do you think is going to happen if you do this? So it's not free, right? So it's not free at all. The taxpayers actually have to pay for this. So the taxpayers are paying for this. And, stop using the word free. Stop lying to everybody, right? It's not free. These guys are going to raise prices considerably, just like the healthcare companies raise prices considerably. Our healthcare costs the most at any place in the entire world because, we fund it through the government. And I just, those two initiatives, scare me. With free college for everyone. Don't say free because it's going to cost taxpayers a lot of money, which means you're going to have to tax somebody on a certain level. And it's going to be middle income. It's not just going to be rich and taking money for the rich because these people can move to different areas. They know the tax loopholes. They're going to be able to avoid this. As much as you want to try and you're putting $80 billion towards the IRS to try to stop these people, it ain't going to work because they're not breaking the law. They're just smarter than everybody else. And that's why they get paid millions of dollars because they save these companies billions of dollars. So just stop saying free. I hate the free word. I just hate it. I got a lot of rants today. I don't know.
Yeah, you are upset about that.
A little bit.
The easiest low-hanging fruit to me, that is, it's easy to sell. Using the word free makes it easier to sell to the public, to get the public opinion behind you. Therefore, you can kind of get your party in line, get everybody to vote, and then try to get some cross-party politicians to jump the aisle with you and vote on and get everything through because it's sales. I mean, that's just an easy way to lay it up. And you get a lot of voters because you put people towards one another. So there's more people that are not rich than there are people that are filthy rich. So that's an easy majority to try to gain traction with and say, hey, these guys are, if you guys tax these guys a little bit more, your life would be a lot better. Of course, it doesn't work. The big thing for me, fundamentally, if you back up or from a 40,000 foot view, is that it's been about 40 years-ish, and the pendulum swings throughout history and politics and economies and all that kind of stuff like normal. So don't freak out too much. It's not time to panic. But it was only about 40 years ago where we had the government and a president saying that individuals were the answer, government was the problem. So now we've switched to individuals are the problem and government is the solution to everything. I'm comparing Reagan to Biden there for everybody that's not paying attention. So that's a fundamental shift. And it's taken a long time, but that's a big deal to go forward because it's only going to get worse. Things like this do not slow down. You can't stop right before a car accident and rewind. So just know where we're at in reality. There's going to be a lot of biasness going forward and a lot of division, but you just got to navigate that and don't panic about the taxes just yet. Frank, I totally agree with you. It's outrageous. We got to see the final print on this and what they're going to try to hammer out. The market will react however it'll react, but you'll get opportunity if things sell off too much. So like I said, and I know Frank's, I'm not putting words in his mouth. He's not saying to panic, but just from that perspective, pay attention because that's a big fundamental shift when you go from what is the problem to what is the answer. Yeah.
I mean, my next job, I'm definitely starting at a university. And it's the easiest way to make money. I mean,
I spent a lot of time in college, so I'm good at that.
Nonprofit organizations, typically, tax exempt. And you look at these endowments, right, which is incredible. Harvard is, and this is at the end, this is beginning of 2020, right? It's probably a lot more now. $41 billion for Harvard, Yale $30 billion, Stanford, Princeton, for $25 to $27 billion.
What are those?
MIT, 17 billion. So these guys are in the business of making lots and lots of money and profits, right? Yeah. Even the Division I colleges, all of them, it's all about profits. Not about education, about profits, right? It's just like healthcare companies. They don't care about curing you. They want to treat you forever. This way they make as much money as they can, right? That's fine. Everybody knows that. But now you know why, where you see the agendas and who they want to support, because free college is, just all these guys are going to go crazy. Not that Harvard's going to be for free. Yale's going to be free, but a lot of these Division I colleges, and they're saying just free college for 2 years, but all these grants that they're going to do and talk community college, you can see college across the board. If you open up this, it's a can of worms. And I'm telling you, it's going to be the worst thing that we ever do. And also, what does it do for the people who paid off these loans? Like, think about all the people who went to college, paid their loans, and work in their
Hey,
off.
you're not trying to make a fair argument here, right?
Just,
I feel like you're going down that road. You're going to drive yourself nuts.
You want separation. You want to really piss people off. You're going to piss off the people that busted their ass to pay for college. You're doing well. You just bought a house, have a family, and now they're going to give all this shit away for free, which, again, is not free at all, right? So you're going to raise my taxes and punish me for actually paying off my student loans and busting my ass to get a really good job and work my ass off. So, but again, it's not logical. It's just whatever. It's all politics. So it's all fun. It's all fun and games, right? Oh, Daniel's laughing because this is Daniel's usually doing the one that's bitching all the time. Instead of bitching today. But.
I do rant a lot about politics, but I don't take it as serious as you. You can't be getting surprised and so fired up. You gotta, like I said, you gotta learn to laugh at this stuff.
Yeah, it's crazy to laugh, especially when you look at COVID and people are dying and stuff like that. It's not easy to laugh, and keeping schools closed when hardly any kids died from COVID, more have died from suicide and all this stuff. It's just, when you look at these numbers and stuff, I get politics. I understand. I know it's cutthroat. Again, growing up in New York and being the Giuliani fundraisers and stuff like that and all kinds of crazy, a lot of my friends are into politics and have moved up the chain. I get it, but not at the expense of people, their lives and stuff like that. Now you're getting a little crazy. And again, now it's there for everybody to see, especially with all this COVID bullshit. And, the CDC is just like CDC. If you did the opposite of what the CDC suggested, we'd all be doing fantastic. Just do exactly the opposite of what they fucking say. Exactly the opposite, and you would be fine. You would be fine. Really, their advice is you got to wear a mask right now. You have to wear a mask even though you get vaccinated because we want to make sure you're not going to, we protect the people who didn't get a vaccine. I mean, think about that. That's insane.
I love Wednesdays. You are fired up today. You're triggered on everything.
But that's what I mean, because now you're impacting people's lives, people's jobs, how they live. That's where I get fired up and I get pissed off. But again, that's what I get for caring. But who cares? Right? I don't know. I'll get tons of emails, negative emails. Daniel, what's your email address again? You got to throw it out there.
Daniel at CurzioResearch.com.
Send them to Daniel.
Daniel at CurzioResearch.com.
Daniel said everything I said today. That's why I don't have to answer them.
That's right. Yeah.
All right, cool. All right, Daniel. Well, as always, thanks for joining us. We love covering a lot of the top stories, a lot of earnings. Guys, please, I'm begging you. Don't just listen to those earnings and on TV and how they beat. Go in and read the transcripts of the conference calls. You're going to find so many great ideas through GE, where they cover so many, not for GE, just so many different areas that they're in, these conglomerates. They're going to tell you what areas of the country, what areas of the world are doing good. I've been doing this for over 20 years. It's the easiest way to find new ideas. Okay, you're going to see different areas that are popping up that you're like, wow, this is starting to grow right now. And then you're going to see it in companies that are pure plays within those specific industries and segments. And it's a lot of fun, and earnings season is really cool. And again, we're going to give you all the numbers. Apple's reporting today. Qualcomm's reporting today. A lot of good companies reporting today. This week, if you are a subscriber to any of our portfolios, we're going to be coming out with lots of updates like we do after every earnings season. Because if we don't like what we hear, of course, our thesis could change. And a lot of our companies are going to be reporting next week. And the week after. So it's going to be really crazy. So expect lots of updates if you're subscribed to any of our products. All right, guys. I've been talking about the crypto intelligence newsletter. We're pulling it. Okay. So we're pulling it this week. So that discount was 50%. I'm glad that so many people have signed up to it. You're going to see lots and lots of great ideas. Again, trend is here. It's amazing. Yes, we saw the tax structure and stuff like that push down Bitcoin. Ethereum really didn't get hit too hard. Some of these things got hit a little bit. Again, they're up tremendously. It's going to give us an opportunity to buy a lot of these things and very, very excited. But if you want to take advantage of that newsletter, again, the access that we have, our average position is up tremendously. And I think those gains are going to continue because we're in a lot of good names, meaningful names. But there is a lot of bullshit in this industry, like Dogecoins and stuff like that you have to avoid. So be sure, if you're getting into the industry, listen to the right people. If that's going to be crypto intelligence, definitely take advantage of it because, we push this open as long as we can. We usually like to do 2 weeks and we extend it, I think, into 2.5, 3 weeks, but it's getting pulled over the next couple of days. So if you're interested, go to our website, CurzioResearch.com. You can sign up. Again, it's a 50% discount, and that's for you guys. So if not, no worries, but that's it for me. Thanks so much for listening. Enjoy the Kentucky Derby on Saturday. A lot of history with me. My dad was the biggest racing fan ever. He used to have his company Christmas parties at FXC Investors. We had probably 10, 12 employees and all the wives and everything and husbands. He used to take us to the Pegasus, which is like the really nice area in Meadowlands, all the way on top to watch the races at night. And we just had a great time. He used to give, $20 to everybody. And again, back then it was enough to bet on a few races. Now, a lot of people will bet that on one horse on one race. And he'd sponsor a race. which is really cool. So if, whatever horse won, they'd be like, okay, you got to come down. We go down, take a special elevator down, go on the track, and then take that, all the pictures are taken when the horse wins. And we met so many great jockeys, Angel Cordero Jr., Julie Crone. Again, those legends. But it was really cool, and I still have those pictures. Anyway, Kentucky Derby's on Saturday. Enjoy. Essential Quality's a 2-1 favorite. Undefeated horse, amazing horse. But as someone that likes horses and bets and analyzes this, which my father taught me to analyze horses when I was 8 years old. I've been to just about every single track you can imagine. It's the first time in over 50 years where horses will not be allowed to be shot up with Lasix, which basically means when you shoot them up with that, they urinate, they lose up to 30 pounds of fluids in a few hours, and they inject them right before the race. This is the first time they're not going to do this. So I suggest betting a few long shots. If you don't think that's a big deal, the last horse to win the Kentucky Derby without being on Lasix was Grindstone in 1996. Drugs are better for horses. If you're going to stimulate them, you're going to make them weigh less. That's what's going to happen. They're going to run a lot faster. So it's going to be interesting that this is the first time they're saying, nope, nobody's allowed to get shot up. So enjoy the Derby. I'd bet a couple of long shots. You never know, since it's been the favorite that's won in like the last 9-10 years. And it should be a lot of fun. So guys, thanks for everything. I'll see you in 7 days. Take care.